Well, as promised, we are about to bring in chart trader Brett Manning. What's up, my friend?
Hey, Jim. How you doing?
I am doing okay. Looks like we've got a nice little rebound in gold over the course of the last week or so. We talked about that dip down to about within I guess about $1 of your stop in those gold futures, and since then we've done nothing but move higher for the most part. So do you want to start there and maybe break down what you're seeing, give us a maybe revisit of your thesis and
Sure.
a potential target, and then whatever change you might have seen in the CFTC data?
Yeah, sure. So, I mean, first of all, let's put it in context. The gold move is part of a network of moves and a network of interconnected markets by positioning by what I see as kind of a single big consensus bet on a conceptual angle on things looking ahead over the next few months. And it basically has to do with, as we talked about last time, the idea that, you know, the United States is kind of, in relative terms compared to China, Japan, the EU, the United States is at a very different point in its cycle, and it's sort of blossoming into its most rapid growth period. And there's stagnation in other places, and the U.S. is augmenting both of those dynamics with its fiscal stimulus here through the tax reform and the way that it's approaching trade policy. So it's kind of tipping those things, exacerbating those things. And I think that people have finally come around to the idea that this is the best way to characterize, at least right now. And I think that that idea has manifested itself in positioning that we talked about last time, with a lot of people flooding in long the U.S. dollar and short gold, the euro, yen, and emerging market assets, and super short bonds, particularly the 10-year futures. So that all is kind of one complex of bets that are all interrelated around this way of looking at the world. And it's a way that I was looking at the world as well a couple months ago, and have been. I see these dynamics. I think it's a very fundamentally supported idea, but the problem is when everybody gets in the same bet, it's bound to start going wrong. And last time we talked, that's where we'd gotten to. There was clear consensus in this bet. And one of the most dramatic forms of that, versions of that, was the short in gold futures, which for the first time in 16 years had gotten net short in terms of large speculators. So it really was kind of this, you know, this sort of zenith moment. And that's not a market based on its internal structure that can handle net short very much. It's not like, you know, 16 years ago it was super net short, and for the 20 years before that, and it's finally changing back into that kind of thing. Even then, it was just a brief foray back into that kind of mode, because a futures market is zero-sum in terms of open interest, and the producers are basically always going to be short because they're long the gold that's in the ground, and gold is not a perishable commodity. So it produces a situation where, just by the mechanics of the futures market, it's extremely difficult to ever get to net short in terms of people who are not producers of gold. So getting there, it really is kind of an extreme. So we have this extreme in short gold, and at the same time, if you look at a very long-term chart for gold, it's very much a higher low relative to a couple of different lows that we've seen at the end of 2015 being the most important one. And that's when we had the first rate hike by the Fed, and that was kind of the, you know, the sell the rumor, buy the news turn in that market that looks to me to be very possibly the bottom of a 3 to 4 year bear market that preceded that point. And if that's the case, then this type of sentiment at a higher low is exactly what you'd expect to see before the beginning of the most important move higher that defines the new bull market, which would be a move, in my opinion, to break out above the 1350 level and maybe head up to test the waters above 1400 and maybe even touch 1500. I don't know if all that's going to unfold, but just as a systematic way of looking at the world, it's an opportunity that kind of checks all the boxes for me. So I needed to get some exposure on, and I felt like there was a good chance that it could kind of puke itself out under 1180. I've seen that behavior in that level before, so I left a very wide stop in a small position. And as you noted, it looks like it came within about, I think it was less than a point of hitting my stop and tripping me out. So that's just one of those lucky situations where it looks like I just left exactly the right amount of room, but obviously, you know, for any kind of margin of error, it really tested what I was capable of staying with there. Most likely after that type of situation, I have a tendency when I have a larger time frame thesis like that to just wait and put a position back on and shrug it off. But, you know, it's nice the way that it worked out. Now the position's well in the money, and I added to it by shorting the Dust ETF, which is actually long the gold miners, in a way that I benefit from both a reduction in volatility as well as a directional move. So, you know, those are my two pieces of that puzzle to try to take advantage of that longer-term picture.
All right. As far as any big changes, you didn't see any in the CFTC as far as this market is concerned, right?
Right. So the CFTC data that came out on Friday afternoon, right before this past weekend, was reflecting data compiled up until Tuesday of last week. So a week ago from today is when the data that you see now is cut off. So that shows an actual increase in the same situation. The gold short got more short. The dollar long got more long. The euro short got more short. The yen short got more short. So all of these things became slightly more, not big, but slightly more. So what you're seeing now, really, these bounces are moves that have basically taken place in most of these markets since that time. And so I would expect this Friday we're going to get data up through today's reality, which will probably show some mean reversion, which is why I titled my notes that way. I think that we're probably starting to see the extremes come back out. And now the real question is, I mean, a lot of times you get trends where you get to a sentiment extreme, then it takes some consolidation, it takes some rebalancing of sentiment and exposure, and then the trend continues. And, you know, it's very much like what we saw in stocks. Stocks in, you know, the January highs, late January highs, early February period, that was a massive exuberance consensus for bulls in equities. It was a historic level kind of thing. And but, you know, the fundamental underpinnings that are driving this trend weren't going away. So you basically just got a crowded trade that had to rebalance itself. And once you find support, and once you go through that process of rebalancing sentiment and exposure so that the extremes peel back out of the market, then you form a kind of situation for the market from which it can move on and extend that trend, which is what we're doing now in stocks. So it's possible that the same thing will be the case in all of these markets that I'm talking about. And what that really comes in, this is kind of the biggest macro theme, I think, for anybody to think about. If you're trying to understand the macro market landscape right now, that's the question. And the question that we're going to be looking at over the next month or two and trying to figure that out. Are we starting to see a greater establishment of this kind of U.S. consensus dominance and cyclicality, where we're seeing extending divergence? The U.S. trade policy is going to keep other economies kind of in check while the United States blossoms behind its fiscal stimulus pathways and the Fed doesn't kill the situation. And we get this kind of cake that just keeps baking in that direction. Or are you going to see a situation where you start to move back toward convergence? And, you know, maybe we see the Dems take the House, put the White House on the defensive starting in November. Maybe the trade policy peels back a bit. The active period of the most dramatic impact of pulling future growth forward into the present of the tax stimulus starts to peter out a little bit on a second derivative basis, and the growth that we've been seeing here starts to get exported a bit because of the strong dollar to Europe, to Asia, etc., and everything just starts to kind of catch up a little bit, and that would be the convergence scenario, which I think is probably my base case to look at. I think we've swung toward the divergence direction probably as far as we're going to be able to go. And now that we've hit this consensus of sentiment, it's going to be tough to kind of juice that back up and go on market momentum again. So I think probably I'm leaning in that direction, that second view, where things are starting maybe to come back toward a reversion to the mean in terms of you know, the real differential in cyclicality in these various places on a second derivative basis. Obviously, the United States is going to be, you know, further along the whole way through until we hit cycle end here and then overseas. But I think on a second derivative basis, is it accelerating away? Are we pulling away? I think probably that process is now maybe mostly complete, and we're looking for maybe convergence, and that may be why we're seeing the dollar not only give up that kind of big positioning spike a bit over the last few days and the last week, but we may be seeing it actually underperform what it should be doing given current data, which suggests the market discounting move back toward this sort of convergence scenario. Hopefully that whole thing makes sense.
It does, I think. Let me just make sure I'm understanding it right. So if you're looking, are you looking at potential second derivative plays out there based on your thesis?
So I'm in them now in the long gold. Really, that kind of plays on the same thing, because if we're looking for convergence, then we're looking for the dollar to move back into a either range trade or slightly bearish context technically over the next few months. So that would be bullish for gold. The other play that I mentioned last week would be picking up emerging market equities, and that's starting to work, and that's something that I may do as well. And staying short the long end of the curve here really isn't against that bet, but it's not explicitly taking advantage of it. But yeah, so the idea would be maybe look to pick up equities in Europe, pick up equities in Japan. China is a different issue, because I think that for China, it really so aggressively comes down to how the midterms are going to play out. And that is, I just think that if the Dems don't take the House and you don't put the White House on the defensive a bit, they stay in this offense mode, then I think that Beijing is not really going to suddenly have an incentive to do what I think would essentially be validating the approach being taken by the White House over the past 6 months. I think that that's their worst case scenario, and they're going to try to avoid that. And I think that what suffers is Chinese equities rather than necessarily even the Chinese economy, because what you lose is the risk premium in asset valuations there. So Chinese economics is really different from a lot of other places, and I put out a note a few days ago kind of explaining this. But China doesn't. Most places, what they do is they measure what's happening, and then they report it on some level. And what China does is it dictates what's going to happen, and then makes sure that happens. And the two mechanisms by which they make sure that happens are leveraging up and fudging the numbers. And leveraging up accounts for much more than fudging the numbers. They really will just put whatever resources they need to into each segment or each little box that they have, regionally and industrially. They'll just pour resources in to make sure that the total level of production gets to where they have assigned as their goal. And GDP is not so much a reading there as it is a target that they make sure they hit. And the question is how much leverage needs to be added to the system to do that. And most other places just don't work that way. And so the question then becomes not is China going to manage to maintain expansion in GDP, but is China going to manage to maintain foreign confidence in terms of its amount of leverage? So if they keep digging their heels in, let's say the GOP holds on to the House and the White House stays aggressive in terms of China policy, then to make sure it continues to hit its targets, China's going to have to lever up more, it's going to sink the currency, and the risk premium is going to come out of equities in China further because of the possibility of a major currency devaluation and a major debt write-down if they can't keep leveraging up to be able to hit the numbers. So I think that's kind of the way it's going to look. It doesn't necessarily mean that China's economy is going to go into the tank. Probably they're going to devalue their currency on a soft basis to try to avoid devaluing their currency on a hard basis. And what you really get is really tight valuations in Chinese equities. And that just means, more downside for stocks there until there is some point, somehow, where we reach a point where, the trade situation resolves itself. And obviously there's one of two ways that's going to happen. One, they kind of give in because they have to, because of maybe, being on the verge of a debt blow-up. or if the Dems take the House and you start to see the White House put on defense quite a bit. So I think that's a really pivotal moment this November in terms of how China does.
So I'm looking at the A shares chart, and it sounds to me as though you are beginning to dabble in some equity ETFs, or at least on the verge of. I'm hearing you talk about maybe some emerging market equities, Chinese equities. I forget which other one you mentioned. I'm going to go back and listen to it so I can hear it. But are we at a point where you're maybe interested in checking out some A shares on the short side? And if not, then where are you?
So, yeah, I mean, as far I'm interested in non-China emerging market possibility on the long side. And that is, that I haven't really put together implementation on that. I'm also interested in possibility of Europe and Japan on the long side. I think China is a unique situation, and I think that it's going to trade according to polls at a certain point here where the U.S. midterms are concerned. Much like we saw Mexico trade according to polls into the U.S. elections 2 years ago. I don't know if you remember how the peso and Mexican equities were kind of like the barometer for how, for the market's assessment of who's going to win the White House. I think that we could see Chinese equities start to act like that around the U.S. midterms for the House. Because I think that the Dems' plan would be to put the White House on the defensive, and I think that probably takes a lot of steam out of how aggressive they're going to be where China's concerned. And we'll see how that works out. But I wouldn't just barrel into long China right now, because I think that their default position is to be willing to take short-term pain for long-term gain. And, from an investment thesis standpoint, that's the worst thing you can hear about a market, even though it may be the best thing for them. Short-term pain for long-term gain means you're going to get a better price if you wait. And that's what I think right now is a base case for China. But in this turn that we've seen in the dollar and the euro and gold and everything else, I think that supports the possibility for other emerging markets to start to play catch-up to the move that we've been seeing in equities everywhere, basically. So I don't know if that makes more sense.
It does, and I've highlighted a move kind of like this many times over, especially in the pre-market, where I'll highlight everything's trading higher and we've got the Chinese markets trading lower. So the S&P will be up 20 points and Shanghai will be down 1.5%. It's crazy how it's almost it's an inverted relationship to the rest of the world, which would suggest that trend would continue based on your hypothesis.
Which relationship? Sorry, which relationship?
I'll see all the markets trading higher. So the DAX will be up, the Nikkei will be up, the S&P will be up, and here we are, the Shanghai will be down 1%, and vice versa. When all the markets are down, the Shanghai will be up. It's a really inverted relationship many times, and I've seen it over the years because I've followed it, been working overnight for many years. So I've seen that happen. It's just now maybe you have a better crystal ball as to maybe the magnitude or predicting this happening as opposed to just watching it happen.
Right. Yeah. I would say I'm not sure how to encapsulate that idea. It's interesting. I've kind of looked at China over the years as the most disconnected and sort of independent moving, when everything else in the kind of large cap first world economies, the markets tend to move very much together, and China can either be in sync with that or not, and almost at random. And I don't know how to understand an inverse relationship there, but maybe if I think about it more, there'll be a mechanism that occurs to me. But I think that independent of whether or not it's moving with U.S. equities or not, I think that it could move higher with U.S. equities or lower with U.S. equities, but I think that it really depends on whether or not we're able to get past this trade war without China really having to give in very much. And I think that is, and it's not so much because of the direct impact of the concessions, it's more because I think that it validates an approach to foreign policy that would be very detrimental for China over the longer term, given the nature of where they are in their longer term structural process. So they really need to still have the ability to have strong trade terms and advantageous trade terms with other major economies who are essentially their consumers. And I think that you can't get rid of that idea yet. They're trying to move toward an expanding middle class and a more integrated internal economy, but they're still dependent upon those relationships. And I think that it's a slippery slope, I think. Once you start to validate a protectionist approach from essentially what amounts to your biggest customer, then I think that it really is a big long-term hit in terms of where China is 10, 15, 20 years down the road. And I think that's where their mind is. And so, I just don't see them giving in when they can go through this process of playing hardball. And it's a command economy, and there's huge power consolidation in Beijing, so they can weather the storm for quite a while, and I would imagine that they believe they can weather the storm for longer than the White House. And, it's really a question to see whether or not that thesis is correct. But I think the Dems taking the House would be a major move toward helping them in that process, simply by placing probably, I would assume, quite a bit of heat on the White House here domestically.
All right, so let's talk about domestic equities then, and the market as a group, as a whole. So I guess we'll focus on the S&P if you want.
Sure.
You had noted earlier, and I was away from the desk when you posted on the page, and I think you might have worded it wrong just on the page. From your chart trader post, it said, would be surprised to see some gap fill here in the indices. I assume you meant you wouldn't be surprised.
Did I?
Right?
I meant I wouldn't be surprised.
Yeah. So I wanted to make sure that was clear, because we still could get it. I mean,
right.
we are trading in negative territory, but just taking a look at the SPY, we're not even close to closing that gap yet. So I mean, there's still time, and I'm glad I could get you on here to clarify that for everyone. So walk us through why you think that.
No, well, we did. It was a really short-term thing.
I thought you meant the. Oh, I'm sorry. I thought you meant the gap that we made. So from Monday to Friday. Excuse me, from Friday to Monday, because we had a gap open yesterday. We traded higher in the SPY, and here we are. We're basically flat on the day. I thought you meant maybe we'd gap fill the Friday high.
No, I was watching the Nasdaq come down right around that 75, 76 to 75, 77 area, and the S&P was coming down. The S&P was closer; it was almost at gap fill, and the Nasdaq was maybe 10 points away. And I just meant, it's going to spill through and touch that level, just the overnight gap. And as I published it, we just spiked down 10 points. So the flaw that I thought was there was simply that I hit publish too late, because by the time it hit the page, we were just about filling that gap. And it was a very quick move, but it was just the idea that a lot of times when you see this type of grinding, trending move, and you get a little bit of a gap up, if you start to see some mid-morning weakness, it's almost impossible to avoid that little puke out that just dumps down and touches that, that gap fill. And I just meant for shorter-term traders who are sitting there wondering when they might want to buy into the dip if they're bullish, or cover a short, or whatever, that probably we were going to see a little bit of a spill there just to complete the process that we'd started over the last hour. That's it.
Okay, so then my interpretation of it was incorrect. We do have a gap that could be filled potentially from Friday to Monday.
Yeah.
Oh, I guess if you're going to look at it from a short-term prognostication for the next couple of sessions, what are you seeing? Do you think this is a short little buy the dip and we're going to get a rally back up and make new highs, or what's your take?
Well, I mean, I just think handicapping it in general, my bias is grinding uneventful long side at this point. It's just we're right back into that really low VIX wall of worry kind of mentality. I mean, if you go through, I'm constantly streaming through all the different sentiment indicators that I look at, and since I put out my chart book a few weeks ago, I've basically been of the view that this market is just going to grind higher because the earnings growth is there to support that, and we have sentiment data that just gets pinned right in this middling stage. There's no exuberance. And there's, one of the phenomena that we've seen over the last couple of years is just a huge shrinking in the size of the market. I mean, all the buybacks, all the private moves, there's way fewer shares out there right now, and it just keeps shrinking, and people are not aggressively involved in what's there. And so if you add those two things together, it's just going to take moments like we saw in January, the occasional kind of capitulatory bull consensus before you're really going to get any kind of substantial correction. I don't see how this market's going to act any different. If we had problems in terms of, starting to see some hiccups and some chinks in the armor as far as the earnings growth story, then that would be a different picture. But we haven't seen that. There's nothing out there that suggests that. And, without people being overly crowded into the stock market, and with the stock market being much smaller than it was even 2, 3, 4 years ago, I don't understand how you're going to win by shorting stocks right now. I mean, there may be some scalps here and there. There's always a possibility of scalps, especially if we get some emotion back in. If we get the VIX up to 15 to 20, there's going to be some some dancing to the music when the music starts playing. But the music is not playing right now, and we're in a grind to the upside with a very even-handed kind of sentiment picture. Plenty of little macro scares popping across the wires every day that shake things out a little bit, and then it restabilizes and grinds back up. And that's just not the type of market you want to focus on being overly aggressive in, particularly if you're talking top-down trading and particularly if you like to short. It's tough.
Do you know how the VIX is actually calculated?
Yeah, I mean, talk about putting somebody on the spot there, Jim. But
well,
I would say,
if anyone's going to know, I knew you would know.
Well, it's actually the options that are on the SPX index, the cash index options. So it is one of the Greeks as a cumulative for the index options bets for the S&P 500. So the implied volatility.
Okay.
So, but here's what it means. What it means is, okay, just whatever the VIX is. So right now it's at 12.33. That means that based on options activity on the SPX cash index, so the options that are traded on that cash index, based on the options activity, that implies that the consensus bet right now expects that over the future coming 12 months from now until 12 months from now, that I believe the range of movement, one way or the other, will be 12.3%. That is what the number means. So when the VIX is at 30, that means people are now preparing for the possibility that either up or down, the cash SPX over the next 12 months will move 30%. Okay?
Okay.
That's what it means. I'm positive of that. So, when you start to see volatility, that obviously that up or down thing really probably means down as people start to get worried about a crash or something. When you start to see that kind of market, you have the possibility of moving lower by 30%. That's people starting to worry about a bear market. And now that is the implied volatility from the options activity on the SPX cash. Those are hedges. So it doesn't necessarily mean people believe that's what's going to happen. It just means that they are putting in place bets using the options market that could hedge for that possibility.
So when you see on CNBC that such and such analyst is baking in a 12% increase in equities this coming year, so their year to date they see it 12%. That's what they're gauging it on, huh? They're just using the VIX model. Well,
they might be. I mean, I have no idea what they're gauging. They might be doing some kind of basic valuation ratio deal. And
well, of course they're going to tell you that, but really, they're just using that.
Maybe, and the VIX is, the VIX is not necessarily an accurate prognosticator by any stretch, but it just shows you that, well, especially on the downside, here's what people are scared of. And right now, this kind, when you start to get below, the way that, as I said a moment ago, there's two different markets. One, the music is playing, the other, the music is not playing. And in late August with a 12 VIX, the music is not playing. There are individual decisions being made that are completely separate and independent decisions being made in separate offices by independent people who are reacting to their own ideas, rather than there is this sweaty monster of a crowd moving around back and forth. And in my experience, people get sucked into that herd, people get sucked into that crowd when information becomes more uncertain and more important. And when the market starts moving a lot, that's exactly what happens. People are not sure what's happening. If you imagine a crowd of people out in a city square, this is what I always kind of think of to understand this. If you've got a huge number of people out in a big city square, you know, and suddenly somebody starts looking up and going, oh my God, what is that? And somebody else does it too, who's too far away for it to be the same person. You know, you see a bunch of people start to go, oh my God, what is that? And then people start to run all in the same direction. What are you going to do if you're there? You don't see anything, but you're probably going to start running with the people who are screaming and going, oh my God, oh my God. You know, that feeling of, oh, this is really uncertain, I don't know what's happening, but it could be significant enough that I could get seriously injured or killed. I'm going to go ahead and react to what people are doing around me because I don't have any other source of information. And that instinct to go, oh, wow, this is really important, and I don't know what's happening, so look, everybody else is doing this, so I'm going to do that too. That starts to happen in markets when volatility kicks up. And what I've found over the years is it is a whole lot easier to make money when that's how the market is acting than when it's acting like this, which is a very independent-minded group of people who are not acting like a crowd at all and who are all making their own independent, rational decisions. It's tough to look from a top-down basis and start to guess what everybody's going to do when people are acting that way. But it's easy to understand and guess what people are going to do when they're acting the other way. Hopefully that makes sense.
It does, but how do you make money in a environment like this then? Because it's been like this for quite a long time with very few pockets of
I know.
That VIX above 20.
Yeah, and that's the trick. I mean, there's a number of strategies. Bottom-up guys, I think, have a general advantage in this type of market. Guys like Scott. Scott's got a great system for this type of market in terms of he likes this. This is what he likes. He likes not having to worry about what the quote-unquote market as a whole is doing because he's got his special little setups that he follows in his bottom-up approach for his individual stocks. And if he doesn't have to worry that the S&P is about to do something important and screw things up for his setup in his particular stock that he's focused on, then he stays with that setup. And for top-down guys, I think you have to be a little bit more selective. And one thing that I do is I focus on these bigger themes, larger time frames, more patience and smaller size, and also have something in play. And I've suggested this a number of different times. If you don't want to do bottom-up trading, for periods when the VIX is low, there's nothing wrong with having something where you just take a sum of your capital and you even put it in somebody else's hands to just, you know it's going to be long only, and you can take that strategy off whenever you want. You reserve plenty of your capital to trade for yourself, but you know that's there. It's just plodding along, and it's not subject to your own impulse to start worrying about a top here and there along the way. And so you can take hedge bets against that. You can take strategic moves like we've done in gold and the gold miners, and you can follow your longer-term plays. And, you know, August is probably the most dramatic version of lack of involvement in terms of day in, day out trading for me. I know that, you know, it's a thin market. It's kind of the apotheosis of that version of a market where you've got a small number of people who are very independent-minded, and it's just, I think the signal-to-noise ratio is awful for top-down trading in a situation like where you've got the lack of emotion and then you've also got low volume and thin action. It's just, you just do not need to be doing that with your time. Look for individual setups if it fits your system, but September and October are historically some of my best months where I tend to get a lot more active. For one, we tend to get more volatility, but for another, you've got the crowd coming back, and you've got big top-down decisions being taken by big investment managers for the period from when the banks have to start kind of placing their book. There's a September process for the banks is important. They always have to kind of get ready for the year-end numbers the following quarter. And so there's, I think, a process where everybody takes a look at, well, the summer's over, the banks are done with that process, we're going to have a dependable lending environment starting in October, and we're going to get positioned for what we believe is going to happen till the year end, until we get bonuses and everything else. And I think that that period from maybe the middle of September to the middle of October is often when you get some of the most interesting macro trades that start to transpire, and in equities as well. And you get turnover of positions, you get shakeouts that are a little bit bigger, and you can get some spikes in the VIX, you can get some opportunities to jump in alongside. But doing too much of that sort of thing on August 28th is not something I advise.
Well, that sounds like good advice, but it also sounds like a nice little prep for that things may begin to perk up a little bit in the coming weeks.
Yeah, I mean, I would imagine, generally speaking, as I trace my behavior over time, September and October are generally two of my most active months in terms of intraday trading, and I would expect, that'll probably be the case again this year. August is always the lowest level of activity.
We'll call it the calm before the storm.
Yeah, basically, right? I mean, everybody agrees, look, we're all going to go on vacation. And, you get that kind of situation. People know that the boss is out of town and they're not supposed to make any major changes, and it takes something dramatic. 2015 was an obvious exception. We got a huge crash, we got a huge spike in the VIX, and I think that part of that was that situation. I wrote a piece about this a few weeks ago. Basically, I said, August has made it pretty much something, I can't remember exactly, but something like, hey, there's a 95% chance of boredom and a 5% chance of scary. And that's kind of how it works. When the big boss is away on vacation and the junior traders are manning the desk and something starts to go haywire, and you throw in this one other element, which is the junkie traders, people who have to trade every day, all day, no matter what. If anything moves, they're going to bet on it somehow. There's folks like that in the market, and they're going to be trying to make money no matter what's going on every day. And, those guys have to trade at 3 times the size right now because the market doesn't move enough. So when you've got the guys who are trading too big, and you've got a thin market, a lack of liquidity, and then you've got, nervous junior traders managing the desks at the bigger places, that's a recipe for, if things start to go wrong, it can really snowball into something crazy for a couple of days. And we've seen that a few times over the last 10 years, with 2015 being the most dramatic. I think we had a 10% crash in the Dow in 3 days. We had a limit down on the NASDAQ in that period, which I think that we have not seen for 10 years before that, and we haven't seen after that. We had a limit down. I think that I had a long trade that day where I made I think 285 points in 20 minutes on the long side.
Was that MiniFlash Crash day on the open? Apple gap down like huge. It was like shortly after the open. We had 2
crash days before it, and then we had that. Yeah, so we had 2 crash days, and then the third day we came in, and the NASDAQ opened limit down. It was just the people were just scared, not knowing what's going on, and the market was too thin, and everything just got thrown overboard. And yeah, I think Apple was one of the victims there. But as soon as we got just a minute or two after the open, it just launched.
Yeah, I remember that day.
We went like 5% in just a few minutes. And then, we kind of ground along, squeezed back higher into the winter, and then we had the huge short in the S&P in late December. But it was all part of that, that 2015, 2016 kind of lateral correction in the markets. But that was one of the most important features, was the August crash. So it can happen. And generally, that's the way I treat August. I say, hey, first show me that you're going to be doing something important, and then I'm going to get aggressive. But if it's like this, I'll keep my positioning as it is. I've got some interesting bets on. Because I'm just sitting here in the bets that I have, I'm making money just about every day, and I'm not putting new money at risk in a situation where the signal-to-noise ratio is terrible.
I want to hear something funny. I was cleaning off my desk just this morning, and I stumbled across some old notes that I took from. I didn't date this thing, but I'm guessing it was a conversation that you and I had, and it says bear thesis intact, back above slope resistance, 50-day around 2700-ish, then a meltdown lower. 2700. Doesn't that seem so long ago?
Yeah.
That was at the beginning of the year.
Yeah, right.
And here we are, 2900.
Yep. And
those were the days.
Those were the days. We had some VIX, we had some trading. Now we're in the grind.
Yeah, so
I think September's going to be awfully interesting, and I think that for a lot of different markets, there's always some changes. There's some turnovers, there's some reassignments of capital, and everything just simply gets more interesting when people are back after Labor Day.
Thing is that if we did go back down to say 2700, let's say on a correction, we really would have done nothing. The whole year would have just been a wash.
It happens.
And that's not a bad thing. In context, you're like, oh, it's, we've just seen a melt up and then a little bit of a dive lower, and it'll seem like the world's coming to an end again, but it really net right? Everything's fine. We're still at 2,700. Even if that does happen, it's crazy how that sentiment will shift so quickly. We weren't talking, oh, it's going to be, great times ahead if this thing goes from 2,700 to, and I even had a price objective written down here. I'm not sure if it was an objective or maybe a short that you were looking at 2665. So I don't even know if that rings a bell in your memory banks. But
when was this?
I don't know. It had to be close to the beginning of the year. Probably around February-ish.
Yeah, I had a couple big shorts in there, and then one that went way in the money and came back on me and didn't end up working.
I bet you that's this one, because I did write down equals big short.
Yeah, I mean, I was looking for 2550 to 2500 on a kind of dump down below to test or break the January lows before turning around and starting to buy for year end, and it just got truncated. People stepped in, and it couldn't unfold.
Yeah, but back then we weren't saying, well, if this doesn't work out, this is going to be glory times ahead, because we're going to be 300 points higher in the S&P.
Yeah, well, I was looking for a year-end rally. I mean, I wasn't looking cycle end, as I recall. I was looking for a check back to dump out the lows, January, February lows, the February lows.
Yeah, well,
that was the point was to dump that out, and really get a washout of everybody who was, because we still had sentiment data to me that suggested that there were some weak hands involved in the market, and I wanted to see that get washed out, and I thought it could make for a great kind of back to the upside.
Hey, Brett, I don't know if you can hear me or not.
That purging process right at the inflection.
Are you able to hear me? Because you're
I can hear you.
Okay. Yeah, your audio cut out. Yeah, it cut out for just for a few minutes, or
can you hear
for
me
a
now?
few seconds. I can now. Yeah, you were talking about an inflection point on that low.
Yeah,
shaking them
I
out.
was just saying, I'm not sure whether it got through, but I was saying one of the things that's always troubled me a little bit is when I see a situation where I would like to catch a turn or inflection, and there's a washout level, and the market is never able to kind of purge, never able to kind of get to that process of breaking the significant level, purging out underneath it, and snapping back, but just kind of sits above it and turns and moves, and that's exactly what we saw in I believe it was early May. So.
Yeah, well, I just wanted to take a trip down memory lane. Who knows?
Yeah, there it is.
Maybe we'll get that in the next several weeks. We'll definitely stay tuned for that. Anything else that we might not have touched on that you want to highlight?
I think we've been pretty comprehensive.
All right. Well, as comprehensive as we can be in a summer, late August trading day on what's today, Tuesday?
Yeah.
Yep.
It's getting tricky.
It does. When you have kids, you just lose track of the days. They all kind of seem the same, don't they?
Yes. Exactly right.
I'll tell you what. I'll wake up. I'll wake up at 3 in the morning on a Saturday and go, I'm late, just because I'm such in the groove. So. All right, my man. Well, until next time, maybe we'll touch base at least early next week when the new CFTC data comes out, but more than likely, I suspect we'll have you on maybe Thursday or Friday if you are so inclined.
Got it.
All right, my man. Thank you so much, as always.
All right.
All right.
Got it. Thanks, Jim.